My name is Andrew Stotson. Welcome to the Valuation Master Class Show. Today, I'm going to go through my global investment strategy. Yesterday, I talked about general strategy themes. And what I want to do today is talk about the particular themes that I'm investing on. Let's look at that for just a second. Also, if you want to receive this, you can message me at Andrew Stotson. I'll send you this PowerPoint. All right, so let's get into it. The first thing I want to mention is that this is my 2026 global asset allocation, and I'll call it high conviction tilts for a multipolar world. Now, it's important to remember this is not market cap weighted. I don't really tie that much into market cap weighting. And it's definitely not a traditional 60-40 portfolio, although sometimes it can be because I change. And it's built around deliberate global tilts, right? I'm looking at things globally. And it's based upon structural macro beliefs. Now, before we go into it a little bit more, remember, this is not investment advice. This is just explaining my thinking and my research. Also, what I wanted to highlight as I talk about this is that I don't really set a global theme for 2026. I set a global theme for the next 3 months. And at the end of the next 3 months, I then reconsider my positions and my themes, and I may decide to stay with those themes, or I may decide to move away from those themes. So let's go into it in a little bit more detail. First, here it is. Emerging markets, excluding China, is 25% in my strategy. US equities is 25%, and global equities are 20%. That gives us a total equity weighting of 70%, gold at 25%, and global bonds at 5%. So there's 3 defining tilts, as you see on the right. Overweight emerging markets ex-China. And I'm underweight US because within the global portfolio of stocks only, the US is about 63% weighting. And gold replaces bonds as a primary hedge. Now, I've had the position in gold for 9 to 12 months now, and so there's no big change for that. So this gives you a little picture of the allocations that we're doing. So let's talk about theme number 1, overweight emerging markets ex-China. So basically, for this theme to work, you've got to believe that growth leadership will broaden beyond the US and China. And demographics favor Latin America, India, and Southeast Asia. So they could be markets that could go in 2026. And supply chains diversifying and relocating. Look at Vietnam. That's a major driver for them. And I'm avoiding China-specific policy and capital risks. China is just not attractive to me now. And the way that I built the strategy is such that I can allocate in such a way that I can bring China down to 0 or very low. You're still going to always have some in the world allocation. But ultimately, if we didn't make an adjustment to take China out, we would naturally always have a relatively high exposure in emerging markets to China. So I thought I would have some fun here and want to introduce you to some of the smartest people that I've learned from. Let's look at who agrees with this theme. So Ruchir Sharma, he's a global investor focused on long-term emerging market cycles. And the concept of emerging market leaderships is shifting beyond the US and China. And so now I haven't double checked with him when I made this presentation. So he may have changed from this, or I may not be characterizing it perfectly, but that's my assessment at this point. Then there's the infamous Luke Gromen, who's an independent macro analyst focused on fiscal dominance. He talks a lot about that. And he talks about real economy growth favors non-US regions. So again, I haven't confirmed everything. I've tried to gather as much information I can about their position because I think it's interesting to see who is for and who is against the different strategies. Also, some of these guys I've interviewed, like Luke Gromen on My Worst Investment Ever, and I should get him to come back and talk about his strategy and then go into more detail. Okay, so now the next question that's fun is, who disagrees with this? Well, Stephen Roach, who's former Morgan Stanley Asia chairman and Yale fellow, very famous, and he thinks that China remains central to global growth. And I think he, it could be right. Could be right. I could be wrong on this, but I'm willing to make my tilt for the first 3 months of this year. And Michael Pettis, who is economist focused on China's development model, and China's just too systematically important to exclude. That would be the counter argument to my removing China from most of my exposure. So let's look at the next theme number 2, underweight U.S. equities. So the point is U.S. exceptionalism moderates. It doesn't collapse. The dollar doesn't, let's say BRICS or Euro or Chinese renminbi, as an example, are not going to replace the dollar as a trading currency. They're going to rise, but dollar's probably not going to collapse. Capital and earnings growth broaden globally. Really, we've seen the earnings growth mainly concentrated in the top tech companies, and U.S. equity concentration in the tech companies is elevated risk. In other words, valuation gaps matter over time. If the valuation of companies, and this is an important note that I want to make, I think it's great to buy companies that have a high valuation. At times you can perform very well from that. Particularly, you can capture momentum that is moving on a particular stock. But the problem that you face in the long run is that there's two drivers of share price over time. And the one is, you could call it an intrinsic driver, which has to do with the earnings of the company. Let's say, we'll keep it simple and look at a PE basis. And the second driver is the expansion in the PE multiple. That only happens when there's good news. When news is bad, the multiple tends to contract. And the problem that we face is that the PE multiples are so high in the tech space that it's very hard for their multiples to go up even higher. Meanwhile, many companies around the world are struggling. Now, later I'll talk about US interest rates coming down, possibly, and down strongly. And that could actually really bring interest into countries around the world if it can spread. So Lee says, yeah, it would be great to have Luke Gromen follow up. I agree. And I love talking to Luke, and just every chance I get to listen to him, I've been listening to him as long as I can remember. So who agrees with underweight U.S. equities? Well, Lynn Alden, another incredible superstar. She's an independent strategist focused on fiscal and balance sheet risk and what she calls fiscal dominance. And she sees global rebalancing risks rising. And then there's Russell Napier, who's a financial historian focused on financial repression. And he thinks that the U.S.-centric model will weaken over time. Now, Russell is someone who also worked at CLSA around the time that I was there. He was there for a very long period of time and has written a lot of great stuff. And he's also got a podcast that he started called The Library of Mistakes, which, is a great way of collecting the mistakes that we have made collectively so that hopefully we don't make it. So if you haven't checked out The Library of Mistakes, just type it in and type in Russell's name, Napier, Napier. Now, the question is, who disagrees with this and would say, no, stay overweight the U.S.? Well, Tom Lee, who's an equity strategist and co-founder of Fundstrat, and he's a U.S. equity bull driven by earnings and AI, and thinks that U.S. will remain dominant. So it would be foolish to underweight U.S. equities. And Ed Yardeni, who is a veteran strategist focused on productivity growth and thinks that U.S. leadership persists. Ed's been around for a very long time and is extremely experienced. And so it's very possible that his view on U.S. equity wins out. This is the challenge of doing an investment strategy, is that ultimately you got to put your money down on what you think is going to work. Now, just briefly for those that are watching, just remember that this Valuation Master Class show is sponsored by the Valuation Master Class Bootcamp. The next one starts on February 16th, and just send me a message that says VMCBC at me@AndrewStotts, and I'll give you an extra discount. So let's look at the third theme, gold as a primary hedge. So fiscal dominance limits central bank independence. Bonds no longer hedge equity risk reliably, or let's just say gold does it better. And gold is a non-liability asset. In other words, there's no offsetting liability. Gold does not rely on policy credibility. And also, I would say, and Trump will do anything to reduce interest rates before U.S. midterms. And when he reduces interest rates, it's possible that bonds can perform well, but it's also very possible that nothing happens with bonds. So let's think about this for a minute. I have my discussions I've made on the interest rate in the past, and there's a lot of more stuff I'm going to bring out in the next week or so on interest rates. I think on Monday I'm going to talk about interest rates again, but we'll look at an update as of December. But the Fed controls the short-term rates, and I believe that Trump is going to do everything he can to bring down the short-term rates. And the problem that you face is that if the consensus of investors think that the short-term rates are going to fire up, with short-term rates coming down, it's going to fire up inflation, then what you'll find is that the midterm, the mid-duration, longer duration U.S. government bonds don't go down. In fact, they could go up. And a lot of times when we're looking at corporate bonds, we're generally not talking about short-term. We're talking about longer-term. So this is an interesting one to watch. I feel pretty strongly that Trump is going to lower interest rates as soon as he can and as dramatically as he can in order to win the midterm elections coming up. And I'll mention that in just a second. So so here it is. So the point I've been making over and over again is I think that Trump wants to get the Fed funds rate down from about 3.7 down to 2 and eventually to 1 if he can. And it's going to have a major benefit for the U.S. In particular, the interest cost is almost $1 trillion right now, and that would bring down the interest cost pretty dramatically, which would free up more money for spending. And for those people who thought Trump was a conservative or Republican, of course he doesn't believe in that. As we can see, what he believes in is using the power of the federal government for whatever purposes he wants to do. And in order to use that power of the federal government, you got to have money. And so he's perfectly happy with funding the federal government, whether it's the military or any other parts of it. And so I was never myself under any illusion that Trump was going to, cut. There was a brief moment where he talked about getting rid of the overseas, global tax, which would bring him a lot of votes from maybe, I think it's like 8 million or so Americans that are outside of the U.S. But ultimately, he needs the tax revenue. And so he's a big spender in that space. So he wants to get the interest rates down so he can spend more, not so that he can cut the deficit or something like that. Now, who agrees with this gold as a primary hedge? Well, Jim Grant, famous financial historian, focused on sound money. The Grant Interest Rate Observer is what he's famous for. And he sees gold as a monetary asset. And then Zoltan Pozsar is the architect of the Bretton Woods 3 framework that he talks about. And he talks about a multipolar monetary system favoring gold. Now, we already saw that the BRICS nations were trying to set up their own currency, but in the end, it didn't work. What they ended up setting up was payment systems. We have the Chinese chips system now for payments. And I think that's what you'll see out of BRICS is, how do we do payments without it having to go through US dollar, without having to go through the US? But the idea that there's a replacement for the US dollar, I just don't think it exists. Now, it is a multipolar world, and so we're going to see things shifting slowly in that space, but it can't shift that fast. Now, who disagrees with this? Lacey Hunt, who's a veteran economist and fixed income strategist, and he says bonds are the ultimate hedge, which, is right in the sense that bonds basically can go down when the market goes up and can go up when the market goes down, particularly government bonds. Jeff Gundlach, who is the founder of Double Line Capital, he says bonds are attractive again. And Danielle DiMartino Booth, who is a former Fed employee and she's focused on recession risks, says quality bonds preferred. Now, why am I showing you who agrees and who disagrees? Because I think it's a great way to think about what you're talking about. Because, as an example, Jeff, that I just mentioned, is one of the top bond strategists in the world. So this is an important thing. As I tell my students in the Valuation Master Class Bootcamp, if I'm successful at the end of the bootcamp, you'll be less confident than you are now. And what I mean by that is, never get too overconfident in your opinions. You still need to tilt towards your opinions as strongly as you can and maintain a diversified portfolio. But you can be wrong. And I would say that my idea could be wrong. And Jeff is a great way of kind of thinking about, if he doesn't believe in gold as a primary hedge, then I need to think about it. Now, the purpose of today's session is not to go into more detail about his argument as an example, but at least to raise the argument. Danielle DiMartino Booth was a guest on my podcast, and I really enjoyed her. And she just has so much great energy. But the thing that she really talked about as her worst investment ever was the idea of, kind of don't fight the Fed. When you see liquidity flowing from the Fed, go with it. And if you just remain pessimistic about it, you don't think it's right and all that, markets can fly when liquidity is released. And I think that that's a possibility of what can happen in the US. So if Trump is able to get down interest rates, let's just say, and that brings down interest costs for the federal government, maybe they come up with some solutions of how to try to reduce the debt, the US market could fly. And my underweight position on the US market would hurt. But on the other hand, remember, the US isn't the only equity market in the world. I have exposure to other equity markets, and it's very possible that some of the other markets would fly also. And keep in mind, when volatility rises, oftentimes the emerging markets are much more volatile. And so if it's a positive level of volatility, then it could benefit it. So I've got a little bit of a hedge there by being not only exposed to the US, of course, with the 70% weighting in overall equity. So what could go wrong with this portfolio? US equity dominance reasserts itself. There's just no beating the US, and AI productivity remains uniquely US led, and capital continues concentrating in the US market. Everybody wants to own it. The second thing that could go wrong with my portfolio is, my strategy is that bonds regain their hedging role, and inflation falls and stays low, and rate cuts restore negative stock bond correlation. The next thing is that emerging market ex-China could disappoint. Political risks undermines investor confidence, currency weakness offset local earnings growth. This is an important one because let's just say that, I'm overweight Latin America. If any Latin American currency collapses where I have an overweight position, think of Brazil as an example, then from a currency basis, I could lose. Now, I'll just highlight for a moment that I don't generally prefer not to do hedging because hedging is expensive. And ultimately, currency is generally a zero-sum game. So you end up paying, and over the long run, you're just taking away some of the returns. So now in Thailand, I think the biggest currency you got to worry about is the baht going to strengthen? Because you could say if the baht is going to strongly strengthen, or whatever country you're in, if you're not in the US, if you think your currency is going to strongly strengthen, then it may not make sense to go into international or global markets because you're already going to get an appreciation just coming from the currency. Wait a year, and then once the currency has risen, then take that higher value and convert it into your overseas investment. But of course, who can predict what's going to happen with currencies? And next one is gold fails as a portfolio hedge. Fiscal discipline improves. Treasury Secretary in the U.S., Bassett, could be more disciplined, or a strong dollar. We've seen the milkshake theory come out of, I forgot his name now, but listened to it many times. Brent Johnson, I think it is. Yep. Strong U.S. dollar. So, if we have a strong U.S. dollar, it's hard for gold to outperform. Usually it's an opposite performance between the dollar and gold. Also, you could just say that, well, the gold has had an incredible run. It's risen about 30% relative to all the major currencies in the past year. That's incredible. Maybe it's the end of that run. So this gives you a picture of the way I look at the global investment strategy, the ideas that I have, and how we've put that into practice. Remember, this is not a recommendation. You need to do your own research, which is the whole beauty of investing. It's the part I enjoy the most. And also remember that this Valuation Master Class show is sponsored by Valuation Master Class Bootcamp. The next one is February 16th, and I hope to see you in there. Let's look at if we have any questions here, and feel free to ask any questions. If it's after the live stream, I'll try to answer if I can. Are gold and real estate still effective inflation hedge in a world where AI and energy generation are having an increasingly important role? Well, I would argue that real estate, Roman, what I would say is I would never look at real estate separately from equity markets. Unless we're talking about you owning a piece of land, or maybe a house, or possibly a condo. But outside of that, if you're going to invest in a REIT or some sort of real estate sector, what you're going to find is two things. The first thing is that it's already represented in the stock market. So when you're buying the market, you're buying all the REITs that are listed. And the second thing is that the correlation between real estate, generally, you can find uncorrelated or less correlated. But if you look at real estate for a moment, what you're going to find is that it's pretty highly correlated with the equity market. So I wouldn't look at real estate as an inflation hedge in the equity market. Now, if let's just imagine that you're leasing, your condo or your apartment buildings and stuff. Generally, what happens is inflation can rise very quickly, but ultimately what can happen is that you have locked in a monthly payment from the renter, and you can't just go and increase that. You may have to wait 6 months, 9 months, 12 months before you can renegotiate. And so generally, your rental type of agreements take time to adjust, whereas that rising inflation can hit a lot of places pretty quickly. All right. Jeremiah says, do you think the dollar is going to strengthen and why? You're asking me the hardest question. So I think we need to look at the dollar short-term and long-term. Long-term, it just seems impossible that the dollar can strengthen given the financial position of the US government. So my first answer to this, Jeremiah, is that we'll have long-term dollar weakness. Now, what about the short term? The US government, the US military, the US Fed, the US banks, they all have the tools to force people to use the US dollar, the US trading system. If you try to operate outside of it, they're going to force you back in. If you don't behave the way they want, they're going to force you out. So between that and the fact that even though America is somewhat of a mess, it's still the best place for innovation, for investing, for starting companies. I did see, Jeremiah, some statistic where I was comparing many years ago the cost of government on the P&L of the average company. This was a great study, and it showed their estimate of that cost of government on the P&L of many countries. And when I saw the costs in the US, it was incredible how high taxes are in every single way. So America is super expensive when you think about all the taxes. When you look at countries like Indonesia and Thailand as an example, there's almost no tax. Yeah, the devil's advocate, Lee, is an important one. You've got to always be questioning, as you know, through your trading experience. I want to thank you for attending today's Valuation Master Class show. In this show, I talk about a lot of different things. I think it was just important to talk about global investment strategy. So if you have any questions, feel free. If you want to get this PowerPoint and get more information, just send me a message, me@AndrewStotz. That goes to my personal email, and then I will reply with this PowerPoint and give you more information. This is Andrew Stotz, and I just want to say, I hope that you build a competitive advantage in company valuation in 2026. Why not do it now?